Right now we're in the chapter 7, part 2 handout. Moving quite along. Now we're going to calculate interest on not accounts receivable, but another interest-bearing asset. So accounts receivable really doesn't earn interest for the company, but a note receivable does earn interest. And you can convert an account receivable to a note receivable. Or you can just make a loan. So banks, mortgage companies, they make loans. So do companies, they have notes receivable also. Either way, it's an asset the company owns that is earning interest. Like you would pay on your car loan, a credit card loan, those companies are earning interest. The same thing here. I always think the best way to handle these types of learning situations is to look at an example. On December 13th, and I normally say read the problem, but I think this one I need to read with you. On December 13th, accepted a $9,500, 45-day, 8% note, dated December 13th. Granting Miranda Lee a time extension on her past due account receivable. Then we need to prepare and adjust an entry to record the accrued interest on the loan. Okay. We got a lot going on. And then I'm going to keep on. I'm just going to go on and do what we would do when we get paid later. So I've got like 3 parts of this, even though there's only 2 here. All right. So Miranda right now owes us account receivable $9,500. So what we're going to do to convert that account receivable to a note receivable, we're going to debit note receivable $9,500, and we're going to credit account receivable $9,500. This shows that she no longer has an account receivable with us and is now a note receivable. The adjusting entry, as you recall from the first exam material, we need to make sure that during the year, in year ending December 31st, or even the month, the year ending here, we have the revenue correctly recorded at the end of the year. So we need to create an interest receivable because Miranda's not paying us the interest yet. Interest is receivable and record the revenue that we're entitled to collecting when she pays us the principal plus interest. Well, how do we get to $38? Well, it's been 18 days since we converted the account receivable to note receivable. 31 minus 13 is 18 days. Something else to remember, I'm going to go over this formula, but before I do, I want to show you this right here. Unless it says otherwise in our book, use 360 days. Reason being, back when accounting was manual, there's no computers, 12 times 30, we just treat every month as having 30 days. It turns out to be 360. So we don't care about February or say July. February 28, could be 29 days, leap year, right? Or July 31st, December has 31 days. We just treat every month as 30 days. So back when it was manual, that's what they did, and they just had a 360-day year. Accurate? No, I mean it's 365. Consistent? Yes. Close to accurate? Well, I mean, over time, it's the same amount of money. It's the same amount of interest collected. 8% times 9,500. Is we're just slicing and dicing it a little bit different. 5 days, right, over the year. Back when it was not computerized, it wasn't that big of a deal. Now a lot of systems, 365. Our system at the mortgage company, we changed systems several times over, because I was there a long time. And every single one, in the administrative settings had a choice. Do you want a 365 year or a 360 year? Pretty cool. All right, that was in our loan servicing software. All right, so anyway, we covered the first one. Then the 31st, like I said, it's been 18 days. And we're going to use 360 unless we tell you otherwise in this class. So what you do is you take 18 and divide it by 360. That'll give you the fraction of the year, and that's what we need. Times 8%. Where did that come from? The problem right here where my mouse is. times how much she owes us. Where did that come from? Right here. So 18 divided by 360 times 8% in decimal form, or you could hit 8, press 8 in your calculator, and then hit the percent key. I don't know where that is on my calculator, and I don't care. I always use 0.08 for 8%. 18 divided by 360, whatever you get on your calculator, times 0.08 times 9,500 should be $38. So we'll debit interest revenue, 38. We'll debit interest revenue. I just said that wrong. Interest receivable will debit, interest revenue will credit. That's the end of the problem. But let's continue on. When she pays us, there's a 45-day note. 9,500 times 0.08 times 45 over 360 is $95. So that's the interest she's going to owe us for 45 days. We already accrued 38. So it means $57 yet is due between December 31st and when she pays us. That will mean that cash is debited, interest receivable, $38 is credited, interest revenue, $57 is credited, and what she owes us is also credited, $95. Added up, that's $95.95, which is $95 plus $9,500. That's going to take you a minute to go through again. So I've asked you before, this time I'm begging you. Stop the video, pull out a blank sheet of paper, don't look, rework that problem. I will leave the screen right there. That's how important this is. Try to do it right now on your own without looking. See how close you can get. All three. The 13th, the 31st, and then when paid, just like I did that extra step. See if you can do it. It's important. Email if you need any help.